Welcome to this explainer. We're going to dive straight into the official macroeconomic data to uncover the systemic, structural mechanisms that are actually driving the American wealth gap. We're looking strictly at the numbers here, drawn directly from the Federal Reserve, the Congressional Budget Office, and the Census Bureau, to build a really comprehensive picture of how wealth is truly generated and distributed in our modern economy. It's basically the central economic mystery of our time, isn't it? I mean, over the last several decades, the US has seen profound economic growth, massive technological revolutions, and just immense wealth creation. Yet, despite this massive boom, why does capital continually flow right to the very top? What are the hidden structural forces allowing high-wealth households to consistently stockpile resources at a much faster rate than the rest of us? To even begin to understand the scale of what we're looking at, we have to look at the total pool of resources. Get this, by the first quarter of 2026, aggregate household net worth in the United States hit a staggering $183 trillion. That is a massive, almost incomprehensible number, and it's mostly driven by the ongoing revaluations of real estate and financial assets. But, a nation's aggregate wealth only tells half the story. The real narrative lies in how that massive pie is actually sliced up. Let's jump into Section 1, the Great Wealth Divide. When you look at the Federal Reserve data, the contrast is just stark. As of early 2026, the top 1% of households hold nearly 32% of all American wealth. Meanwhile, the entire bottom half of the country, and we're talking about over 65 million households here, holds just 2.5%. This isn't just a slight imbalance, it's a fundamental asymmetry in how capital is held across the nation. And this concentration isn't just a static snapshot, it's a moving trend that has accelerated dramatically over time. Back in 1989, the top 1% held a 23% share of the wealth. But watch this climb. It rose through the 90s, weathered the 2007 pre-recession peak, totally surged during the 2020 pandemic asset boom, and arrived at that 31.6% mark where we sit in 2026. Which brings us to Section 2, a tale of two portfolios. To understand this widening gap, we really have to look under the hood at what these different groups actually own. There's a deep structural divide here. For the bottom 50%, they rely heavily on home equity and wages. In fact, real estate makes up about half of all their assets. On the flip side, the top 1% completely concentrates their wealth in high-yielding corporate equities, mutual funds, and debt securities. Real estate makes up less than 20% of their holdings. They are literally playing a completely different economic game. When we break down who actually owns corporate equities, the divergence becomes even sharper. The top decile, so the top 10% of households, captures nearly 90% of the entire stock market. The top 1% alone holds over half. That leaves a mere 1.1% of corporate equities and mutual fund shares for the entire bottom half of the country. So when you hear the stock market is booming, the bottom 50% barely even feels it. And as Census Bureau data reveals, the situation is actually a lot more critical for many families. Millions of Americans have absolutely zero exposure to these wealth-building engines. Nearly 39% of households do not own a home, and over 41% have no retirement account whatsoever. For middle-income groups, their wealth is 100% reliant on these two assets. If you don't own them, you're entirely disconnected from the primary mechanisms of capital appreciation. Let's move on to Section 3, wages versus capital gains. Let's dive into how these different asset classes behave in the real world. Simply put, financial assets compound faster than real assets. Just look at the years leading up to the pandemic. From 2016 to 2019, corporate equities grew at an annual rate of 11.5%. Meanwhile, residential real estate, which is the primary wealth engine for the middle class, grew at just 5.2%. Because the wealthiest households have massive exposure to the stock market, their net worth inherently grows at a structurally faster pace. Meanwhile, for the everyday wage earner, inflation acts as a really heavy anchor. According to data from the Bureau of Labor Statistics, even when workers saw their paychecks grow by a solid 5.1% in 2022, inflation basically erased those gains. When you adjust for the cost of living, real wages actually dropped by 1.2%. So labor income constantly struggles to outpace inflation, while financial assets frequently just soar right past it. Because these financial assets grow so quickly, the realized capital gains at the top push income inequality to historic highs. By 2021, Congressional Budget Office data showed the top 20% of households earning an average of $418,100 before taxes. That is roughly 19 times more than the bottom 20%, who earn just $22,500. This massive divergence in income perfectly mirrors the divergence we saw in asset ownership. Okay, moving right along to Section 4, the policy and tax engine. So what structural policies are actually acting as an accelerant here? Well, the crucial point is how capital is treated versus labor. Data highlights a tax system that heavily favors the investor over the wage earner. First off, investment returns are generally taxed at lower rates than ordinary wage income. Second, taxes are deferred on unrealized gains, meaning your stock portfolio can grow by millions without you paying a single dime in taxes until you sell. And third, massive unrealized gains can often pass across generations completely untaxed because of exemptions at death. Furthermore, as the wealthy accumulate more, they naturally save a lot more. The Federal Reserve actually has a specific term for this. They call it the saving glut of the rich. Because top earners couldn't possibly spend all of their income, they pump it right back into the financial system. And ironically, this supplies excess credit that encourages overborrowing and debt at the very bottom. Let's define exactly why this creates such a massive feedback loop. This savings glut drives down natural interest rates, so to manage the economy, central banks have to step in with unconventional monetary policies. These interventions systematically inflate the prices of the exact financial assets like stocks that the wealthy already own, which just further explodes their net worth. This all leads us to our final section, Section 5, the future of American wealth. What you really need to take away from all this is how these mechanisms form a continuous, self-reinforcing cycle. We're observing a fully integrated system of compounding advantages. It starts with portfolios, where capital continually outpaces labor. Then it's insulated by policy, with the tax code protecting those investments far more favorably than everyday wages. Next, monetary interventions act as a massive tailwind to boost asset valuations. And finally, this concentrated capital bypasses the labor market entirely, getting passed directly across generations. This leaves us with a pretty profound realization about the long-term macroeconomic reality of the United States. In a system where financial assets consistently out-earn labor, the fundamental mechanics of wealth creation shift. It's no longer just about earning. It is overwhelmingly about owning. Which brings us to the ultimate question we have to ask ourselves as we look at all this data. If the true engine of American wealth is what you already own, rather than how hard you work, how will the next generation ever close the gap? Thank you for joining us for this explainer. We'll see you next time.